In September 2008, as Lehman Brothers collapsed and global markets entered freefall, something strange happened. While millions of Americans watched their retirement accounts evaporate overnight, a small group of hedge fund managers made billions betting against the housing market. One fund alone netted $15 billion in profit. Coincidence? Maybe. But here's what keeps economists up at night. Every major financial crisis in the last century followed an eerily similar pattern. Credit expansion, deregulation, warning signs ignored, sudden collapse. And always someone positioned perfectly to profit from the chaos. Today we're going to examine evidence that suggests economic crises aren't random acts of financial nature. They're the predictable result of deliberate policy decisions. And once you see the pattern, you can't unsee it. Background to understand how crises get engineered. You need to understand one fundamental truth about modern economics. Our money supply is uncontrolled by governments. It's controlled by central banks, private institutions, with extraordinary power and, crucially, almost zero public accountability. The Federal Reserve, created in 1913, operates with a mandate that sounds reasonable: maintain stable prices and maximum employment. But here's the mechanism they use. They control interest rates and the money supply. Lower rates mean cheap borrowing. More money printed means more cash flooding the system. Think of the economy as a bathtub. The central bank controls the faucet. It can make the water level rise rapidly by opening it wide, flooding the system with easy credit. Or they can slam it shut, draining liquidity and causing what they call corrections. But here's where it gets interesting. These aren't random adjustments. There's a cycle. It's been documented for over 2 centuries. The Austrian economist Ludwig von Mises identified it in the 1920s. The boom-bust cycle, he called it. Print money, lower rates. Create artificial boom. Assets inflate into bubbles, then contract. Raise rates. Watch it all collapse. Repeat. But Mises asked a question that got him largely ignored by mainstream economics. If this cycle is so predictable, so damaging, why does it keep happening? His answer was troubling, because the people controlling the faucet benefit from the cycle itself. The origins, let's go back to where this system really crystallized. The creation of the Federal Reserve. It's 1910. 7 men take a secret train journey to Jekyll Island, Georgia. No last names used. Extreme secrecy. These men represented the most powerful banking institutions in America. J.P. Morgan, Rockefeller's National City Bank, Kuhn Loeb and Company. Their mission: draft legislation for a central bank. Why the secrecy? Because Americans hated the idea of central banks. The country had already killed 2 attempts at central banking in its history. People understood that whoever controlled the money supply controlled the nation's economic destiny. But these bankers had learned from previous failures. They wouldn't call it a central bank. They'd call it the Federal Reserve System, making it sound like a government institution. They'd give it a noble mission: stabilize the economy and prevent panics. The Federal Reserve Act passed Congress in 1913, slipped through just before Christmas when many legislators had already left Washington. President Woodrow Wilson signed it. Years later, he allegedly expressed regret. "I have unwittingly ruined my country." What had actually been created? A system where private banks could now effectively create money out of nothing through fractional reserve lending. With a central bank backstopping their bets, profits would be privatized, losses would be socialized. The first major test came quickly. The rise throughout the 1920s, the Federal Reserve held interest rates artificially low. Credit was cheap. Money was everywhere. Stock market didn't just rise, it soared. Between 1924 and 1929, the Dow Jones increased 400%. This wasn't organic growth. This was inflation of the money supply, creating an asset bubble. But here's the key detail that gets buried in history books. The insiders knew. In early 1929, while the market was still climbing, Paul Verbro, one of those men from Jekyll Island, now a Federal Reserve Board member, began warning of an impending crash. He and his associates started quietly liquidating their positions. Then, in August 1929, the Fed suddenly reversed course. They raised interest rates. The money spigot shut off. The crash everyone now knows came in October. When the dust settled, thousands of banks had failed. With the big banks, they survived, better than survived. They acquired their failed competitors for pennies on the dollar. J.P. Morgan bought up banks across the country. wealth concentrated upward at unprecedented rates. Was this planned? Here's what we know. The Fed had the power to provide liquidity. They chose not to. They let banks fail for 3 years. The money supply contracted by a third. Only the politically connected banks received emergency support. The Great Depression that followed wasn't an accident of overheated markets. It was the predictable result of monetary expansion followed by sudden contraction. The pattern would repeat. The breaking point fast forward to 2008. The pattern had played out again, just with different assets. This time it wasn't stocks, it was housing. And the setup was remarkably similar. Starting in 2001, after the dot-com bubble burst, the Federal Reserve under Alan Greenspan dropped interest rates to 1%. They held them there for years. Money flooded into the system. But where would it go? Banks now operating under deregulation passed in the 1990s, we'll come back to that, began making loans to anyone with a pulse. No income verification, no down payment. Subprime mortgages exploded from $35 billion in 1994 to $625 billion in 2005. But here's where the scheme got sophisticated. These terrible loans got packaged into complex securities called CDO, collateralized debt obligations. Ratings agencies, paid by the banks creating these products, stamped them as AA rated. Safe as government bonds, they claimed. Wall Street knew differently. Internal emails from this period revealed later in lawsuits show executives joking about the shitty deals they were selling to pension funds and foreign investors. And some insiders did more than joke. They bet against the very products they were selling. Goldman Sachs famously shorted the housing market while selling CDOs to clients, a practice that fraud in any other industry but somehow remained legal on Wall Street. Then, right on schedule, the Fed began raising rates in 2004. By 2006, rates had increased from 1% to 5.25%. Adjustable rate mortgages reset. Homeowners couldn't pay. Foreclosures began. The collapse was catastrophic. But again, notice who suffered and who profited. The fallout: 10 million Americans lost their homes. Unemployment hit 10%. Retirement accounts were decimated. Total household wealth dropped $16 trillion. And the banks, they got bailed out. $700 billion in taxpayer money through TARP. Trillions more through the Federal Reserve's emergency facilities. The very institutions that created the crisis were rescued by the public. But here's what should make your blood boil. Many of these banks were simultaneously paying record bonuses. In 2008, as the financial system melted down, Wall Street paid out $18 billion in bonuses. The justification? The banks were too big to fail. If they collapsed, they'd take the economy down with them. It was financial hostage-taking, legitimized by policy. Meanwhile, regular homeowners received almost nothing. Promised assistance programs were deliberately complicated and underfunded. Banks that received billions in taxpayer support foreclosed on millions of homes, often homes they did and even legally owned due to fraudulent documentation. The wealth transfer was staggering. The richest 1% recovered within 2 years. Everyone else took a decade, if they recovered at all. The wealth gap in America, which had been growing for decades, exploded. And the people responsible? No major Wall Street executive went to jail, not one. Compare that to the savings and loan crisis of the 1980s when over 1,000 bankers were prosecuted. What changed? Political capture. By 2008, Wall Street wasn't just influencing policy. They were writing it. Failed fixes. After every crisis comes the promise of reform. Never again, politicians declare. Regulations get proposed. The public demands accountability. And then, quietly, systematically, those reforms get gutted. After the Great Depression, we got the Glass-Steagall Act, separating commercial banking from investment banking. It worked for 60 years. Then, in 1999, with massive lobbying from Citigroup and others, it was repealed. After 2008, we got Dodd-Frank, meant to prevent another meltdown. It was 2,300 pages of regulation. Sounds impressive. But by the time bank lobbyists finished adding loopholes and exemptions, it was largely toothless. And starting in 2018, even these weak provisions began getting rolled back. The pattern is consistent. Crisis occurs. Public outrage demands reform. Reforms pass with great fanfare. Lobbyists immediately begin dismantling them. Within a decade, The system is back to where it started or worse. Why does this keep happening? Follow the money. Between 1998 and 2008, the financial industry spent $5.1 billion on lobbying and campaign contributions. That bought them deregulation. After 2008, they spent even more. That bought them bailouts and immunity from prosecution. Revolving door spins constantly. Treasury secretaries come from Goldman Sachs, then return after their government service. Fed chairs get lucrative speaking fees from the banks they just finished regulating. The people who supposedly oversee the system are the same people who profit from it. This isn't capitalism. It's not even a free market. It's a rigged game where certain players cannot lose because they've captured the rule makers. Modern parallels now? Let's talk about right now, because the pattern is happening again, in real time. Since 2020, the Federal Reserve has printed more money than in the entire previous decade combined. Trillions of dollars flooded into the system. Interest rates went to zero, then stayed there for years. Where did this money go? Not to regular people, despite stimulus checks. The vast majority went to asset holders. Stock markets hit record highs during a pandemic. Real estate prices soared beyond 2008 levels. Billionaire wealth increased by $1.8 trillion, while millions lost their jobs. Then, in 2022, the Fed began aggressively raising rates, the fastest increase in 40 years. From near zero to over 5% in just 18 months. The predictable consequences: regional banks started failing. Silicon Valley Bank, Signature Bank, First Republic all collapsed in a matter of weeks in 2023. The Fed and FDIC stepped in with emergency measures, effectively guaranteeing all deposits at the biggest banks while letting smaller banks fail. Sound familiar? Should. But here's what's different this time: the scale. The asset bubble isn't just in one sector. It's everywhere. Stocks, bonds, real estate, cryptocurrency. Everything got inflated simultaneously. And the debt. Total U.S. debt now exceeds $34 trillion. Corporate debt is at record highs. Household debt is breaking records. When this bubble pops, not if but when it'll make 2008 look small. Who's positioned to profit? The same institutions that profited last time will suffer. The same people who suffered last time. The data is stark. Since 1989, the wealth share of the bottom 50% of Americans has dropped from 3.6% to 2.5%. Meanwhile, the top 1% went from 23% to 32%. Every crisis accelerates this trend. Takeaways. So what do we do with this information? 3 critical takeaways. First, understand the cycle. Economic crises follow a pattern: artificial credit expansion, asset bubbles, sudden contraction, collapse, consolidation. When you see cheap money flooding the system and assets inflating rapidly, start asking questions. Not about whether a crash will happen, but when, and who's positioning themselves for it. Second, follow the incentives. When someone tells you a policy is for stability or preventing panic, ask who benefits. The people with their hands on the economic levers have consistently used crises to concentrate wealth and power. This isn't conspiracy, it's documented history. Bank bailouts, quantitative easing, emergency powers. Look at who profits from these necessary interventions. Third, demand actual accountability. Real reform requires breaking the revolving door between Wall Street and Washington. It requires prosecuting fraud, even when committed by powerful institutions. It requires public oversight of central banks, not independence that shields them from democratic accountability. The system won't reform itself. It's working exactly as designed for those who designed it. Conclusion here. The uncomfortable truth. Our economic system produces predictable crises because powerful interests profit from the cycle. Boom, bust, consolidation, repeat. Each crisis transfers wealth upward. Each recovery leaves regular people further behind. Is every detail meticulously planned? Probably not. But the system itself is designed to produce these outcomes. And the people running it keep choosing policies that perpetuate the cycle, even knowing the consequences. The question isn't whether another crisis is coming. It's whether we'll continue accepting the same script. Privatized profits, socialized losses, no accountability for those responsible. Right now, we're in the late stages of another cycle. The warning signs are flashing. The question is, Will you see it coming this time? If this video changed how you think about economic crises, share it. These patterns only persist because most people don't see them. Hit subscribe for more investigations into the systems shaping our world. And leave a comment. What patterns are you seeing right now that worry you? The next crisis is being built today. The only question is whether we'll let it play out the same way again.